Hello, everyone. Welcome to another webinar. Tonight's obviously the Thursday, the 11th of March, and we do have a bit to discuss tonight. So I'm just going to go through the main setup before we get right into it all. The first thing that I do have to check off the list is that if you are looking at opening an account at ACY at the moment, they do have a 15% deposit bonus. It's only going to be held up until next week, Friday. So if you are wanting to do something about it, then feel free to jump in pretty quickly. After the 29th of March, ASIC's new regulations don't allow us to do this sort of stuff anymore. So there will be obviously no more deposit bonuses. But of course, that's at your own prerogative. Now, moving on from that, a little bit about me. For those of you who might be new tonight, my name is Alistair Schultz, and I am the Chief Market Analyst for ACY Securities. Now, I've got more than 15 years trading experience, getting closer to more 16 years by this stage, and that includes time spent on the trading floors of New York and a variety of different brokers and boutique investment funds. So I do know my way around a couple of different types of charts. I've also a published author. I'm currently rocking out and working with a publisher at the moment to establish a second edition and probably add some things that are a little bit more current to the day's needs, as opposed to when I wrote it a couple of years ago. And of course, I do a lot of trading coaching. I do things like what I'm doing now with webinars, but I also do one-on-ones. My most high-profile student has been Tim Cahill, but I have had a variety of others that now consistently work in the finance industry in one way or another. Outside of that, I do a lot in media side of things these days. I'm a guest speaker on AusBiz TV. I've been featured in the Australian Financial Review, Sydney Morning Herald, Bloomberg, FX Street, Finance Magnets, you name it. There's usually a quote somewhere for me that you can find. Now, really moving forward from this, where did I all start? My journey started obviously 15, 16 years ago. And I've worked my way all the way from being a technical analyst when I was first starting out, trading mostly FX markets, to really establishing to a much broader scale and looking at a very broad picture of markets and, of course, techniques as well. So I've found that in my own sort of journey that I think that everyone has a different personality, and their trading style will generally reflect that. So because everyone has a different personality, they will have a different way of trading. And it's not about finding or copying the best trading. It's about finding what works for you. And that's really the most important element of it. There are good traders on the technical side, good on the fundamentals. It really makes no difference. It's about finding the compromise that sits in your path. And it really is a bit of a journey to get there. Now, moving on to how to talk to me. Tonight, as always, I tend to focus on the Zoom side of the session. So if you are watching from YouTube, I'm probably not going to be able to see your live chat, just because I don't have the capacity to keep my eyes on absolutely everything going on at the same time. So if you are on YouTube and you want to leave a comment for me, then do so through the comment section. Don't use the live chat function, because when I close this meeting or the Zoom meeting, it tends to erase those messages and I can't find them again. So leave a message in there for me just like this, and I will reply to as soon as I possibly can. Now, if you are watching through Zoom, then please feel free to use the chat function that you've got. Obviously, in the bar at the above, you can see just on this line here. If you're not quite sure where that is, or it's hidden from your screen at the moment, then the other option is you can use some of the shortcuts. There is Windows, on a Windows computer, you hit the Alt button plus the H button, and it'll bring it up. Mac, CMD plus Shift plus H, and on an iPad, Command, Shift, and H. And that will bring up your chat function, and you'll be able to send me a message. Now, with the interest of what we generally go through on nights like this, if you do have a chart that you want me to look at, I always love looking at your guys' trading ideas, purely because if you've got one or you want a second opinion, sometimes it helps solidify your understanding or your ideas, or it might help you in other ways. So I do like looking at those sort of things. Sometimes it brings something to my attention that I may not have been looking at that might give us some good opportunities. So feel free to chime in what markets you're looking at or what trade you're looking at and how you're doing it through that chat function. Now, to move on from that side of things, tonight's agenda. I figured, considering we've seen a lot about stimulus packages this week from out of the US, I thought we would talk a little bit about Joe Biden and the Biden administration's party for the stimulus package that's going forward. Of course, ECB is coming out tonight as well with some monetary policy updates. So I thought it would be a good idea just to cover where their positioning really sits right now, so that you guys can sort of think about the directions on where you might want to go with your own trades. I do have the Aussie dollar up there for the moment, but we know that it is still sitting pretty flat today. markets have been generalized, and obviously your charts and questions. So if you have something that you do want me to look at, then please feel free to chime in, and I will quite happily have a look at them. Now, before we get into anything, I do have to present this risk disclosure warning. This statement basically says that anything I say tonight can't be construed as personalized advice, and that I'm speaking really from a general nature. Now, that means in reality, I'm looking at things that sort of interest me, and I will always try and help you guys to the best of the ability that I can, or under the conditions that I can. But it's always important to know your own investment objectives, i.e., what do you want to get out of that investment? What your own risk profile might be and how you handle risk, and of course, your own experience level. And if any of those three things have a question mark on them, then I would advise that's probably not a bad idea to seek some additional help. If you need some direction in that, then send me a message, which I will put up some of the options for contacting me outside of webinars at the end of this. So leave it for the end. Now, if you do have charts, please put them forward up front pretty early on, because then I can sort of schedule them in a bit easier. We might have to take something out or put something in just to sort of work it all into the time frame, because I don't want to keep you guys away from your families, your dinners, and of course, anything else that you may be doing. Now, to move things in, I'm just going to put a chart up for us to have a bit of a look at to start off with. And considering where the US dollar is at the moment, I do need to update the charts that I'm using on here. I think maybe I can go show all and it'll come up with the dollar index. No, it doesn't. Okay, so thinking about the US dollar at the moment and all the stimulus packages that's going on, the recap really is the $1.9 trillion stimulus bill, which is just massive, that Joe Biden put forth towards the end of Christmas, when he was starting to get traction for getting votes and getting in as president, has effectively been signed off on today. We still have to wait for the official signature from Joe Biden, but it has gone through the Senate. It's gone through the House, the Senate, and then back to the House for the final vote. It was a pretty close vote. And at the end of the day, they stripped a couple of things from the bill to make it get through. At this stage, it looks like any adult who earns up to $75,000 will receive a full $1,400 US as a stimulus check. Anything up to $80,000, they'll get less and less. And then once you hit 80 grand as an individual, you will not see a dime. Now, for the unemployed people, they get a top up to $300 per week sort of thing going on. And the major thing that was taken out of the bill was the introduction of minimum wage increases. So that has been removed, and that is not likely to be going forward. Now, overall, in the stimulus box that they've got going on, if we are to think of it as a mystery box or the magic 8-ball box, where is all the money really going? The first thing is $160 billion to vaccine programs, $360 billion to state aid, $300 per week, obviously, to the unemployed, $1,400 a week per individual. So there's a fair bit of money going out there. $170 billion to schools to try and help them kickstart again as a part of the recovery efforts and getting kids back in there. $45 billion is going towards rental aid. And then outside of that, $14 billion for airlines and airports, and $25 billion for small to medium enterprises, or SMEs, as we call them. Those small companies who may not have been able to handle the coronavirus, or it might just be the local milk bar down on the corner or whatever it may be. That's really where we're looking on that front. Now, the inflation aspect has been the big concern. Now, I am just going to grab a Forex Factory chart so that we can have a bit of a look. This should be the right one, because there was some data for the US, I think it was last night. Yeah, here it is. Now, here's our inflation numbers. We might just make that a little bit wider so everyone can see it. Now, here are our inflation numbers that we were dealing with last night. They're basically pretty much the same. There's not been too much change. Now, where does this mean it sits in terms of the actual CPI figures? I think the other one here is the core CPI, which was down, which is just a 0.1%. Now, whilst it says that here, the real factor is the real numbers are what we're looking at. So we saw February to February. So we're talking February 2020 to February 2021. Your CPI, which incorporates everything, this one here, or consumer price inflation, was 1.7%. So that's almost identical with a fraction of growth to the last year. When we look at the core CPI, now core CPI actually excludes things like food services and the energy sector. So it doesn't incorporate either of those into their searches. And this is the one we tend to follow because you don't get as much fluctuation. And it means we get a little bit of a smoothing effect going on. So you tend to find people follow the core CPI, not so much the standard CPI. And when we look at this core CPI on the month-on-month and even on the year-over-year basis, it actually declined from the last quarter. So, that's all those fears, all that anxiety that people were talking about the other day. We saw the underlying CPI figure hit 1.3%, which was down 0.1%, which is, what this number basically tells us now. And that doesn't mean that it's a bad thing. It certainly means that the worries about an inflation just creeping up way too fast have been sort of hit with the fire extinguisher for a few minutes. And of course, US equities rose. So that was the big one we saw. Now, what did we see in equities that did rise? The best performing sectors were really coming out of the finance sort of things. We're also seeing it on materials sector and mining. Here in Australia, it happened to be discretionary consumables and all those sort of things related to travel because of our own stimulus stuff that was going on over here. So two very different scenarios, but at the end of the day, this morning we were looking at futures in the US rallying and expecting to see the same sort of results. That's generally what happens. You look at the results of last night's action, you look at the futures market and see which way they're sort of ticking up for your respective indexes or markets, and then you aim to look at the derivatives and see if there are any changes on that front as well. Now, realistically, what's happened outside of those US equities rising, we've seen people being a little bit more optimistic about the vaccine rollouts as per normal. We've seen more people pushing towards that cyclical sector, which is why we're seeing materials going up, why we're seeing those sort of cyclical stocks going up, the financials as well. And then the tech side haven't had a great day. Now, whilst it's not a horrible day, and it certainly isn't like what we've seen in the last couple of weeks where they've been sort of tanking down and we've had this massive sort of move. Remember this candle here was where this is a daily chart, don't forget. The candle that I've got the crosshair sort of sitting over the top of now. On that day we saw like Tesla grow 20%. So, that's a little bit of something to think about. Now, does this mean that inflation talk is all over? Absolutely not. Why? First reason being inflationary shocks are going to be likely over the next 6 to 12 months, maybe even 2 years. Main reason being that we're coming from a state, remember I was talking about on Tuesday how we're coming from a place where the economy has basically been in this tiny little hole. And the smallest uptick in inflation is kind of going from 0% to massive percent, or at least that's what it looks like. If we were seeing those figures, at 5% inflation and a small uptick, then you wouldn't bat an eye. But because we are going from zero, imagine a jump from 0% to 1% on inflation in a very short period of time. It'd be, pandemonium. So the other reason for that is that we've now just been introduced to this massive stimulus package. And to me, there's too much money chasing too fewer goods and services. That's really what's going to be happening at the end of the day. What does that actually mean for when we think about the US dollar? Well, for me, I think the magic 8 ball says information too cloudy, come back later. Effectively, you've got a bit of a cloud overhanging or a bit of fog in the way of real direction. I suppose you can think of the idea that if we've got $1.9 trillion worth of value going in, then we're going to be seeing a devaluation on the US dollar side of things. Unfortunately, though, the secondary effect of that stimulus package is that we are going to be seeing more business conducted, which means more economic activity. And usually that will also mean we will see equity markets rise, which we've already seen them doing that a little bit in the overnight session. Now, logically, it means that those yields are likely going to be rising as well. And when yields rise, inflation comes up with it eventually. And whilst we've put the fire out on some of the inflation talk and probably a little bit on the yields, purely because we had a pretty fall over sort of bond auction on, I think it was Tuesday night for the 7-year auctions, or maybe 10-year. It was one of the two, and that's caused people to sort of think, oh, well, it's not really rising as much as we thought. Now, logically, if those yields rise, it increases those borrowing costs, which isn't so great on the economy. But there's more effect. This stimulus package is so large. And if you think of the overflow factor, whenever stimulus package is released by the US or from a variety of Western world cultures and countries that have a fair amount of economic power, you tend to find that a lot of markets that are in the emerging character or a developing nation tend to see this overflow effect. And you can think of it almost like a trading chart, right? As price comes up, their inflation levels skyrocket, the value of their currency skyrockets because they've got all this cash, and then the stimulus stops for them because they're just getting the overflow. Think of it like a cup of water. You're pouring the water in. All of a sudden you get to the top, it overflows a little bit, and you stop pouring. And that's effectively what happens to them. They get these developing nations, the emerging markets, places like Turkey, who rely on the US dollar for exporting. The water then overflows over their economy. All of a sudden, they get this flood of cash and stimulus and money, and then they all of a sudden end up with none. So it sends their inflation skyrocketing and their rate skyrocketing, and all of a sudden they can't afford a loaf of bread. And they go in this cycle of up, down, up, down, up, down, over and over and over again. So, for emerging economies, that is a bit of a problem. Now, one of the key things that I have been keeping a very close eye on has been the flow of money from emerging markets out. And the numbers are increasing, like very, very high. We're seeing a lot of, those places where people would invest, whether it be in companies or businesses or stocks or infrastructure projects, whatever it may be. You're seeing people starting to pull their money out and not parking it in an emerging market or in a developing nation. So, that's obviously, once the investment pulls out, it puts them in a pretty predictive point. Like it's a problematic situation for them. So I would be a little bit concerned about that. Now, the other one to be keeping in mind is what we've heard from the Fed. The mantra has been effectively, we're continuing $120 billion of bond purchases per month. We're not going to be letting rates move anywhere. We're going to continue to allow inflation to run hot until we reach our target of somewhere in the 2 to 3% range. In my mind, that's closer to 3% than 2%. And from there, and we're seeing the yields and that side of thing being sustainable at some stage. And that means that, that's optimism for the market as the way they see it. Now, markets are pretty much ignoring that. And when you start getting markets going against the Fed or against the central bank, you end up with some pretty interesting scenarios. And usually it happens when there's too much jawboning going on. So I think I've described to you guys before about what the aspect of jawboning is. It's effectively trying to talk a currency up or down. In this instance, they're trying to talk down inflation and they're trying to talk down yields on bonds. So, the more that happens, the less people are going to pay attention to it, is effectively it. The more you say something, the less it means something, right? And that is really what this sort of scenario is going from that front. Now, thinking about it from, our markets on the S&P 500, the NASDAQ, the Dow Jones, it stands out pretty clear. Dow Jones has made new highs today, 32,372 right now, or what is it? No, 32,424. When the previous highs that we'd really seen were not even 32,000 in the last couple of days, at least from a solid close above. So that's indicative of that great rotation I've been talking about, that push towards value stocks and NASDAQ, not contracts not performing quite as well. Now, financial and material sectors are really leading the charge today, but overall, this week's been kind of weird. If you look at the ASX, every morning, the sort of morning forecasts and reporting from, people like myself and probably some that are much more educated than I am, have been sort of talking about the idea of, oh yes, markets were great last night in the US session. Markets are going to be great for the ASX today. We should see a push up, and you get a spike at the market open. And then it falls flat and you end up with a flat market for the day, and in some instances closing below the open. So it's been one of those weeks where you sort of got a little bit of people. I think there's a fair few people sort of just sitting on their hands. They want to see the results of this stimulus package. They want to see the result on where it overflows to and what countries it comes back into. and that side of things. Now, the ones that did do well today, we did see, so this is kind of just a bit of a recap point, I guess, for you following on from the US talk. Asian stocks have done pretty well today. They've rallied a bit. Chinese stocks have gotten some modest gains as well. And it's really been sort of put in check, or at least the dollar and treasury yields have really been put in check by that inflation report that I showed you just moments ago. The CSI 300, which is one of China's bigger indexes, rallied the most in about like 2, maybe 3 months. And that's extended, rebounds across this. This is a pretty key week because I've got the National People's Congress meeting going on as well. Which one of the things from there that I did notice today was that they were going to be increasing or wanting to increase defense spending for the chance of conflict with the US. So that's something to keep in the back of your head. In other words, investing companies with bullets is probably not something I would do. And then outside of that, 10-year treasury yields, have really sort of held below. Now tonight, we've got 30-year auctions occurring for the US. So we've seen the dollar being pretty flat today, and they're really waiting on that. So every single time we see something happening good, it was the 10-year yields that happened the other night. Now it's the 30-year yields. And the 30-year and 10-year ones are much harder for them to really sort of control. They can target the 2, 3, maybe the little bit longer dated than that, but that's it. When you get to the longer stuff, it's so far out that anything you do now with the Fed is not going to affect what's really going on. Now, and because we've had that weaker consumer price data, that's kind of eased some of our concerns about potential overheating in the market. But the mood is still remaining quite cautious, particularly on those growth stocks and the tech companies, which have suffered, would ultimately suffer the most when yields do eventually rise with some sustainable hold to it. Whilst we've seen, all those cyclical things continue to recover. So it's not inconsistent to have high yields with stocks going up. But if growth expectations are the driver, then that's okay. But if inflation is the driver, then that's when you start getting a bit of a worry. And all the indications that we're sort of getting from the central bank right now is exactly that. They're looking at the idea that, growth is the driver of optimism and not the inflation. But when you listen to the Fed, they kind of say a little bit sort of a twisted wording there. Now, moving on from that, let's have a think about the euro tonight. And the euro dollar wouldn't be a bad place to start. So what I might do for this one is, whilst I'm sort of talking my way through what we're hearing from the ECB and what I think is probably going to be happening, I think it's probably not a bad idea to be sort of marking up some charts. I don't know your time frame, so for anyone who is new tonight, I try and mark up all the charts just so I can cover your time frames respectively. So we'll start at a monthly level. I'll put a couple of lines on whilst we're sort of going along. So first place of interest is obviously going to be targeting our highs and lows that stand out the most. The next ones that sort of stand in place to me, like you could put one there. You've got this point as a connection, but it's not the strongest one, but it's obviously doing something right now. And you've probably got one down around here. Realistically, anything in between this range between, the parity to the US dollar and the 1.23 is where it sort of tends to stay. We know anytime it gets over the 1.23 or to the 1.25 range, we get a little bit of intervention usually happening, particularly after the events of the GFC. A strong euro is not something that the ECB likes or the European Union really likes, because it affects how they're able to conduct business internationally in a negative way. It's not a great sort of place. So these are sort of two of the areas that I don't mind looking at. I've got one here as well in between this range, just in there, that is not a bad placement. So I'll put one in there as kind of our middle barrier line. It's kind of, you could put it on that side. I think that's probably the best line, the best fit for it. And we'll change the color of that one because it's kind of like dead center, isn't it? So, if we leave it in a nice bluey color or something, we'll know where it is when we see it later on. Now, moving down the time frames. Now, down our daily charts, we've been in a downtrend for, a 2-3 weeks really going on. But, in between that, we've had a bit of consolidation. So, we're sort of waiting to sort of see the next steps. And this on this time frame, you get a little bit more information. You're not quite getting as much noise as you get on a 5-minute chart, but you're certainly, getting a little bit more data than you would on a monthly. So at this point, where price is right now seems to be a bit of a barrier for it. You've got this low here, giving us, at least from a technical perspective, a little bit of resistance. Whilst on this side, we're getting a little bit of support from the sideways action that has happened, back in July 2020. So there is a little bit of interest in the current pricing that we've got now. And I would anticipate that we're probably going to see a little bit of movement over the next couple of hours when we do start seeing the ECB come in. Now, if you wanted to do something on the immediate interim, you're not quite sure, this is something that I sometimes quite often do. I'll put a trend line there. And if I get price to tick back below, I'll take a short position and I'll hold that position until it crosses my trend line again. Once it crosses that trend line, I close out, I'm done. So that's just a little, one of those little things that you can do on the fly. Now, we'll move ourselves down to the 4 hour, see if anything else stands out. Not really. That trend line does become a little bit more useful, but we're already out of the money on that one. So I wouldn't even really consider taking one just at this point. But you could always sort of do a bit of a double up on that side, but still not a great line for us to be using tonight. This one here might end up being useful later, but at this point, still not going to be giving us a bit of a hand. But in terms of where we're sitting in price, now that we know this is our pink line from earlier, we also have our blue one a little bit further away. So from here to here, we've got roughly 350 pips, so it's a long way from price. And the top side is pretty much the same. We're sitting at 400 pips. So these two support lines we've done on the monthly chart aren't going to be useful to our immediate trading unless we see some crazy stuff happening from the ECB. These targets are, these pink lines on both sides and this blue line are sort of areas for us to keep in mind. And if we were to see price get nice and close to them within sort of 100 pip, and then we saw a reversal starting to happen, that's when we want to take advantage of that situation. For the immediate moment, we're not wanting to do that at this stage. And we are starting to get a small uptrend, but it's on the overall downside that we've been in for a while. All of this is, you can trade it, but it is somewhat a sideways market on a 4 hour, which does make it a little bit challenging to sort of deal with. Now, moving us down time frames, just trying to sort of squash it up so it looks a little bit easier for us to sort of identify what might be happening. At the moment, we've still got this same sort of trend sort of going on. It's not even really a trend. You could probably put it from this side over here and run something like that if you wanted to put a bit of a support line in there to give you a bit of a guide for tonight. But at this point, we're still sort of waiting for things to be defined. You can classify this as a trend. You've got more than 2 points of contact. It's on the right side. Price is moving up. But you do have, all of this downtrend sort of coming on. This here is not a bad looking sort of little reversal. It's not a perfect. It's almost like it kind of looks like an upside down head and shoulders sort of pattern. But again, it's not perfect. You're not getting exactly what you're looking for. Things are quite off center and misshapen. So, I tend not to want to take too much advantage of that. In terms of support at this price level, we've got one there. We can definitely use this area as a support line for us to work down. If price was to come back down, nice opportunity to look at, nice opportunity for a stop loss to be sitting in as well. Now, moving us way down the 15-minute chart, before I start talking about the ECB tonight, right now you can see where price is actually going up. We're at the 1.19 mark. We're getting pretty close. We're still a little way away from that 1.20 line, which is usually something that a fair bit of attention gets drawn to, but we are still very much in that upward cycle for the moment. Now, thinking about tonight's ECB event, when we think about it, we're obviously going to be hearing from them. I'll just check the time zone timeline for us on that now, so it's going to be 11:45 p.m. for me. I'm on Australian Eastern Standard Time for this chart. So currently it is 7:31 p.m. We've got a couple of hours to sort of go. And then we're going to be hearing from Christine Lagarde at 12:30. So she's the president of the ECB. Now, there are a couple of things to sort of consider on this front. Inflation talk is an interesting topic for the ECB because they're going to have to talk about inflation and how it's going to affect the recovery. Okay. That all sounds great. We've heard the US doing it. We've heard about Australia doing it. Big difference though. Australia and the US already have some form of recovery really happening. The catch is for the ECB, the recovery really hasn't started yet. They are still getting soft numbers, soft results. They're still not, they've got, so much more to really use. The other aspect of this is that the US stimulus package actually kind of gives a bit of a threat to drive inflation up for the UK and the EU. That is not an optimal circumstance when you are still struggling to get recovery impact. Like you think about it, Australia, the US, Japan, all of these countries are kind of like, oh, we don't want inflation. We want inflation to come, but not too quickly. This stimulus sort of package, just like that overflow effect that you get with emerging markets, has the tendency to flow into other markets like the UK and the EU. So that's not a great scenario for them to have happen. And they want to try and avoid that, or at least, well, they can't avoid it now because they're obviously going to be getting the stimulus package is effectively going to be signed on Friday or Saturday morning for me, but Friday morning for some of you who might be overseas. Now, what do we kind of see from the ECB sort of going on at the moment? The jawbone's the big thing. We've spoken about the jawbone before. The jawbone and the ECB are like, butter and toast. They really do use jawboning a lot. Mario Draghi was very renowned for it, the former president. And now we've got the same sort of thing happening with Christine Lagarde, the current. So while it's, the most common line I think we hear is financing conditions to remain favorable. That's the one line you pretty much read from the ECB week in, week out. And while that is very clear to central bankers, that's a very opaque sentence to traders. It doesn't provide a sense of how much they're actually going to be purchasing on the bond purchases, asset purchase programs. And it certainly doesn't give us an estimate on timeline for that either. It's just, okay, cool. Financing conditions are going to remain favorable. For how long? When does that actually start up? Has the recovery started yet? What are you going to do with the rest of the $1 trillion you've kind of gotten quantitative easing and in funds? And that brings up the second issue. Their QE program has been dawdling. When they first started the QE cycle last year, and when they increased the QE cycle, I think it was in just before Christmas, would have been like November maybe. They were talking about purchasing $20 billion per month of sovereign bonds. And yeah, that's huge. That's not huge compared to the US, but very, spade to spade, a little bit different circumstances. But regardless of that, they've still got I think they've got a total of like $1.75 trillion available over the last little while. And they've still only they still have $1 trillion sitting in the bank, just sitting there, gaining interest or whatever, or probably not gaining interest because of how low bond rates are. But that's a problem. Really we need Christine Lagarde, to really explain why that's happening, what the actual financing conditions mean, what they see as the financing conditions, and what they see as it remaining favorable. How is that a favorable scenario? You still have a lot of problems going on. And without buying, without doing bond buying, you're likely going to see fear starting to creep back in, yields starting to spike again, inflation spikes starting to occur, and some pretty difficult circumstances to try and control. When you start getting spikes like that, it's not good for your economic sort of futures in that sort of sense. What's really contributed to this problem has probably been the slow rollout of vaccines across all of the EU. They haven't done a very good job at that compared to what you see in the US. Here in Australia, it's been, and New Zealand, it's been whilst it's not been great on vaccine rollout, we're only just I think we've had maybe 100,000 in Australia now. But they lock down pretty hard and tight. So we've had that benefit going for us. But the EU, it's kind of a mixed bag, and they haven't been able to get the vaccines out there. And that actually puts a threat in place for more lockdowns to potentially occur. If they can't get a handle on it and can't get that happening, perhaps they should use the ECB QE funds, the quantitative easing, all that stuff from the PEPP, the Pandemic Emergency Purchasing Plan, or whatever it was called, to sort of get that happening. The last thing they want to avoid, or the last thing they want to happen, is a taper tantrum. Taper tantrums are not good, and they do create a bit of a problem. And I think it's almost by sheer luck that the euro hasn't really resurged higher, because they've been, with how much the US dollar has devalued in the last sort of 6 to 12 months, they are very, very lucky that hasn't boosted that sort of side of things. A stronger euro will effectively impede their recovery. So I think the more likely scenario from the ECB, and when we look at these sort of longer term charts, we have been on a downtrend for the last the couple of months. You could call it from here maybe, on your daily chart that we've been on the downside, which really puts us somewhere in that sort of November, which ties into where we saw more stimulus coming in, somewhere in around here, and that's the whole purpose of it. So depending what they say about stimulus and how they want to talk about the next sort of run, is potentially going to be something to look at quite closely. And that's what I'm looking at as well. Now, in terms of the watch list for the ECB, I'm sure you guys want to know what I'm sort of thinking and what I'm going to be watching for specifically tonight. Now, the first one is the financing conditions, that word that they keep on using. I want to see what that means. Increasing borrowing costs is not wanted, nor should it be wanted at the moment. So realistically, I'm going to be watching the 10-year GDP weighted yields and the German bonds and Italian bonds spread. Both of those are going to be seeing where they're going to be targeting money. I'm going to be watching them on the charts, but I'm also going to be listening to what Christine Lagarde says about the 10-year GDP weighted yields and what they think about the German to Italian spread on bonds. Now, the other one, bond purchases. The PEPP bond purchase program needs to be stepped up. Currently, $12 billion a month. That should be much higher. $18 to $20 billion a month will give us some pretty good growth forecasts and build that recovery step starting to move into play. The next one to sort of look at is their growth forecasts. I'm sort of on this one. I'm sort of looking at sort of two things. I think the next 2 points I sort of have that I'm really paying attention to. I'm not certain they'll mention a huge amount on it. I think the growth forecasts are likely to come in. I'm expecting that they will probably cut their forecast, i.e. reduce or contract them after the fourth quarter results, which showed a contraction in the economy. So this time around, I'm expecting they're going to try and, reduce that number so that it can be a little bit more, I don't know, maybe give them better numbers next time around. But I'm expecting them to sort of reduce that growth forecast for at least, the next 2 quarters. And realistically, that's probably the right thing to do. I'm probably looking for contraction expectations from the ECB. Like, we want to know that they know that there's going to be contractions over the next sort of, for the first half of this year. And then all that, whatever they do with the stimulus money is going to help boost the program. The next one is probably, some introduction of similar methods to what Australia, Japan, and the US are using. So in this instance, I feel they have 2 options to sort of walk down. One option on the left is yield curve controls. So in Australia and Japan, we have been purchasing bonds of varying natures, generally low maturity ones. So in the sort of 2 to 3 year government or sovereign bonds, and we've been doing that to try and keep those yields as low as possible, so we don't get that hot shot of inflation starting to rally up. So that's option one. They can. We're really looking for them to have some form of fresh stimulus, or at least use the stuff they've got, and do it this way. The other one is to do the US method, which is we're going to purchase the bonds from corporate side of things, but we're also wanting to see inflation run much hotter. So, they really have 2 choices. Obviously, they've got a target between 2 and 3%. But if they turn around and say, we're happy to let inflation run a little bit hotter for a little bit longer to make sure that we're starting to get that up, then that's what they're aiming to do. And that could be one of the 2 methods. Now, the reason that I am so focused on the inflationary side of things is I'm just going to use a chart here that, ignore where I'm drawing the lines, but, there's an intersect point that they're really looking for. Now, if we think about wage growth and employment as this line here, and the next line would be inflation coming up this way, right? When we get to a certain point, we get this intersection that goes on. And this is like your happy medium. This is the point where no matter where price goes, we're cool. We're going to be okay. We've got maximum employment, inflation's at a healthy level. We've got interest rates at a reasonable level. People are getting wage growth to happen, not just being employed, but they're actually starting to get, increases in pay and or promotions and all those sort of things. The economy is chugging along nice and sweet. This is the equilibrium. This is the sweet spot. But the further you don't introduce some level of rate control to try and bring this inflation down, the more this becomes a problem. Instead of it going like continuing up, you end up in a scenario where effectively after this intersect point and it goes on, your inflation starts to run too hot. That inflation running too hot actually has the counter opposite effect when it comes to wage growth. It becomes too expensive to hire people. So that means you actually have to let employees go just so you can employ the key ones that you actually really need in the company. And then it keeps going even further. And as that keeps going up and up and up and up, it makes the running of a business almost impossible. So, we want to avoid this scenario. We want to stay at this point. But by the time a central bank can actually respond to this, it's already past that because they react to things. They're not forward thinking like that. They have to wait until they see the data before they can do something about the data. So, that is really the problem. That's still a while away, but, the focus now is if we start seeing sort of spikes, if this is the inflation line, sorry, that's the wage and employment line. If we start seeing spikes happening, along the way up, all of a sudden we get an uptick that makes, the intersection of the employment line kind of off point. And that's where we sort of go, okay, well, is this going to be stabilized or is it just a short, quick pop or reaction to what's happening? So, that's why I've been focusing so much on that and why much of the world has as well, because it affects a hell of a lot at the end of the day. Now, I'm hoping you guys have learnt a lot tonight. I hope you have enjoyed the session. I know we haven't gone through as many charts as we usually do, but there's been a lot to consider when it comes to this sort of thing for tonight. I've given you guys a bit of my expectations for the euro and what we want to see. Obviously, if we don't see them addressing some of those issues, the financing conditions and what they think about 10-year GDP weighted yields and German-Italian spread and the increase of their current purchase program, then you would anticipate a little bit of disappointment and likely an increase in value on the euro side because less M2 money supply. If we're looking at the other side of things, looking for the contraction expectations, I'm not so worried about that one. The forecast, on what they think for the economy and the yield curve controls, I think that can wait a little bit to be implemented or installed or talked about. But I would like to hear something about it today. But that's not the biggest priority. Biggest priority is really what they mean when they talk about the financing conditions and the 10-year GDP-weighted bonds, and of course, what they're going to do about bond purchases in general, and are they going to up it from 12 billion per month? If they up it, then most people are going to be happy. We're going to see yields getting a little bit softer and people not worrying so much about inflation. If they decide to do nothing, then expect to see some sort of spikes in value starting to kick in along the way. So I hope that has kind of given you guys a bit of forethought for tonight. I'm going to be focusing on European markets this evening, the euro dollar, euro pound, and I'll be keeping an eye maybe in the US session, depending on how tired I get, for what we see next on this stimulus package that's inbound. So I will leave you all to it. And of course, if you do want to get in contact with me, I'll just bring up that slide for us to have a bit of a look at. Now, of course, if you do have something that you would like to get in touch with me, then you've got these options at the top of your screen. The ACY YouTube channel, please feel free to comment on this. You can get in touch with me on LinkedIn, on my Instagram, or at my Twitter. And I will quite happily respond to whatever I can. And if you want to catch me on any of the live things, I'm on a couple of times a week. So this 9:40 a.m. on the drop is once a fortnight. And then I'm on every Thursday on the opposing fortnight. So it does start to get a bit challenging. And then I'm also on The Trade, which is on a Monday. So there's lots and lots of TV stuff going on at the moment. But, if you do, AusBiz is free for you guys to actually watch on. So feel free to chime in. There's more than just me on there, and it's probably not a bad way to go. Now, I will leave you all for the evening. Like I said before, I hope you have enjoyed it. I will look forward to seeing you all again next Tuesday at the same time, 7 p.m. Australian Eastern Standard Time. And we will be talking about some more at that point in time. Speak to you then, and happy trading endeavors.